Sometimes, the most important stories in markets don't arrive with drama. They don't crash through headlines. They don't trend on social media. They don't feel urgent. They arrive quietly, in earnings calls, in regulatory footnotes, in balance sheet decisions most people skip past. Today's story is one of those moments. JPMorgan Chase, the largest bank in the United States, a name that feels almost immovable. Right now, analysts are talking about a possible path toward $297 per share, not because of excitement, not because of growth hype, but because of something much quieter: capital and cost. On one side, JPMorgan may be sitting on more capital than it needs. On the other, it faces an expense base pushing past $100 billion a year. So here's the question worth asking. Is JPMorgan becoming more valuable or simply more expensive? And if the stock really does move higher from here, what is actually driving it? Let's slow this down and look at what's really happening. To understand JPMorgan today, you have to understand what it has become. This is no longer just a bank. It's a financial system inside a company. Consumer banking, investment banking, asset management, credit cards, corporate lending, trading, payments, all under one roof. After the 2008 financial crisis, JPMorgan emerged stronger than most. While other banks were shrinking, selling assets, or retreating, JPMorgan expanded, carefully, methodically, with regulators watching every step. Then came the pandemic. Then came rate hikes. Then came stress in regional banks. And once again, JPMorgan didn't just survive. It absorbed. Deposits flowed in. Clients moved money to safety. Confidence concentrated. But strength comes with obligations. As JPMorgan grew larger, regulatory capital requirements grew heavier. Operational costs grew higher. Compliance became more complex. By 2024 and into 2025, JPMorgan was no longer being judged on survival. It was being judged on efficiency. And that's where today's tension begins. If you follow financial media right now, you'll hear a few familiar themes. Some say JPMorgan is unstoppable, that it's the safest place in global finance, that size itself guarantees success. Others focus on capital return, share buybacks, dividends, the idea that JPMorgan is about to unlock value by releasing excess capital back to shareholders. There are even claims floating around that JPMorgan is being held back artificially by regulation, and once that pressure eases, the stock will surge. But on the other side, there's concern. Rising expenses, technology costs, compliance costs, legal reserves, compensation, a business that now spends over $100 billion a year just to operate. Some investors quietly ask, is this a growth story or a maintenance story? Is JPMorgan expanding or simply carrying more weight? These questions don't trend, but they matter. Let's strip this down to the essentials. JPMorgan's story right now is about capital efficiency. Banks are required to hold capital as a buffer. It's protection for depositors, for the system, for confidence. JPMorgan holds a lot of it, more than many regulators strictly require, more than peers, more than it historically needed. That capital does two things. It makes JPMorgan safer, and it makes JPMorgan slower. Capital sitting idle doesn't earn much, it doesn't grow, it doesn't compound. So when analysts talk about upside toward $297, they're not talking about explosive growth. They're talking about release, the gradual ability to return capital through buybacks and dividends as regulatory pressure stabilizes. But here's the other side of the equation: expenses. JPMorgan now operates at a scale where every small inefficiency becomes massive in absolute terms. Technology investment alone runs into the tens of billions of dollars. Cybersecurity, cloud migration, AI infrastructure, payment systems. Then there's compliance, a permanent cost of being systematically important. Then compensation. To attract top talent in trading, banking, and engineering, JPMorgan pays like a tech firm inside a regulated institution. This is the $105 billion expense wall, not a sudden spike, a structural reality. So what's actually happening is a quiet balancing act. Can JPMorgan return capital without eroding its margin of safety? Can it control expenses without weakening the machine it built? There's no drama here. Just discipline. Here's the part most people overlook. JPMorgan doesn't need to grow faster to justify a higher valuation. It needs to grow cleaner. When you're this large, incremental improvement matters more than expansion. A slight improvement in efficiency, a modest reduction in expense growth, a stable regulatory environment, these don't sound exciting, but at JPMorgan's scale, they compound. Another overlooked point. JPMorgan's expense growth is not random. Much of it is defensive investment. Cybersecurity is not optional. Technology modernization is not optional. Compliance is not optional. Cutting too deeply would look good for a quarter and dangerous for a decade. That's why management moves slowly, why buybacks come in waves, why guidance sounds cautious. This isn't fear, it's stewardship. The stock market often misreads patience as stagnation, but in banking, patience is often policy. In the near term, JPMorgan's path depends less on earnings surprises and more on signals, regulatory tone, capital rule adjustments, expense discipline. If capital requirements stabilize, shareholder returns become easier. Not guaranteed, but possible. Longer term, JPMorgan's advantage remains what it's always been. Trust, scale, infrastructure. It's not trying to be exciting, it's trying to be permanent. That's why price targets like $297 shouldn't be seen as a prediction. They're a reflection of structure, of balance, of restraint. The upside isn't about speed, it's about durability. JPMorgan doesn't tell dramatic stories. It tells quiet ones, stories written in capital ratios, in expense lines, in regulatory conversations most people never hear. Whether the stock reaches $297 or not is almost secondary. The real story is this. JPMorgan is no longer proving it can grow, it's proving it can manage what it already is. And in a financial world that changes constantly, that kind of discipline is rare. Not exciting, not loud, but enduring. And sometimes that's exactly the point.